Welcome back to another video. Today we're going to be jumping into this article from Morgan Stanley stating that they could see interest rates going as low as 2.5% in 2026. Now I want to talk exactly about what this means, how it's going to impact the housing market, and what is my opinion as to where the economy is headed and how that is going to impact interest rates as well as mortgage rates, because they are two completely different things. If you're new to the channel, my name's Ian Phillips. I'm a realtor in Southern California, and I love talking about the housing market, the economy, and how everything fits together. So if you're interested, subscribe for more, and let's get straight into the video. Okay, so jumping into this article, Morgan Stanley predicts 2026 rate cuts to 2.5%. or 2.75%. And where we stand now is around 4.5%. It's very important to know that interest rates are different from mortgage rates. Interest rates are essentially the amount that the banks pay to borrow money from the Federal Reserve. And mortgage rates are what consumers pay to buy a house. Now, typically, mortgage rates will be around 2 to 2.5% higher than the base interest rate. So if we get 2.5% interest rates in 2026, then mortgage rates could be around 4.5 to 5%. Which is significantly lower than where they stand right now at around 7% at the time of my recording this video. So I want to get into the article a little bit, talk about why Morgan Stanley thinks we are going to have lower interest rates in 2026, and what is a caveat with this prediction. So as of right now, they are anticipating 7 rate cuts next year. Now the caveat with that, like I mentioned earlier, is they don't think we will have any rate cuts in the second half of 2025. Now, this is a little different from investor consensus. Right now, they're anticipating 2 rate cuts starting in September and potentially another one in November of this year. But in 2026, they are anticipating between 4 and 5 rate cuts. So investor consensus is a little different from this article by Morgan Stanley, where they're expecting 0 rate cuts this year and 7 starting in March of 2026. Now, they do cite that inflation expectations are declining. You can see here the expected inflation rate for the current year has been revised down to 0.2%, a decrease from the previously anticipated 0.5%. And this is much lower than where we stand right now at around 2.3, 2.4%. For 2026, they're expecting the inflation rate to be 0.6%, down from the earlier estimate of 0.8%. Now, the Federal Reserve has said multiple times they want to see inflation get below 2% before they commit to cutting rates again. If you're unaware, they actually cut rates by a full 1% in the second half of 2024. Still, I don't understand why they did that, because it ended up actually having no impact at all on mortgage rates, which is typically the reason the Fed will cut rates to begin with. Now, we can debate why they decided to cut rates a full 1% in the last few months of last year, but it ended up having no impact whatsoever. As I mentioned, as it stands, the current interest rate is 4.25 to 4.5%. So Morgan Stanley is anticipating this to basically drop by 2% in 2026, which is great news for mortgage rates, great news for people who have been waiting on the sidelines to jump into the housing market. I know so many people that just want a 5 in front of their 30-year fixed mortgage before they start writing offers on homes. And it kind of sounds like we could get this as early as next year, which is great news. We've been talking about rate cuts for, the last 3 years, 2 years, and so many people who bought with an adjustable rate or a temporary rate buy down in 2022 and 2023 are dying to get out of that high mortgage rate, because a lot of people bought with a 1-year buy down, 2-year buy down, and that is coming to an end, and we still have 7% mortgage rates. So there's been no opportunity for people who bought in the last 2 to 3 years to refinance out of that high mortgage rate. Now, another reason they are anticipating more rate cuts next year is because GDP growth has been more modest than a lot of people were anticipating. We just got the recent numbers. GDP actually came in at negative 0.5% growth for the first quarter of this year. And analysts were expecting that to be negative 0.2%. And just a few months ago, they were actually anticipating positive 2% for the first quarter of this year. So a huge difference. And now for the entirety of 2025, they are having a GDP growth rate projected to be at 1.4%, which is modest from the 2.8% that we had in 2024. So let's talk a little bit about why the Fed would cut rates and what will cause them to cut rates. Because a lot of people don't really know. They just think, oh, inflation's down, the Fed's going to cut, inflation's up, the Fed's going to hike. And that's not really the case. They have two mandates, inflation and unemployment. And one of their primary mandates, which they've stated multiple times this year and in 2024, is the unemployment rate. And I think the reason they haven't cut rates yet this year is because unemployment has remained pretty resilient, around 4.2% at the time I'm making this video. And in my opinion, I think the Fed wants it to be at around 4.5% to 5% before they commit to another round of rate cuts. Because if they cut rates too soon, they're scared of entering into an environment like we had in the 70s and 80s, where we got a second round of inflation that was even worse than the first round, and they ended up raising rates to 15%, which brought the 30-year fixed mortgage rate to 17%. Could you imagine what would happen to the housing market and the economy if we had 17% mortgage rates? No one wants to revisit that time in the 70s and 80s. So in my opinion, the Fed is just being very cautious. They want to see how tariffs impact consumer inflation. They want to see if it's really going to make much of an impact. As it stands, it hasn't really affected anything too much, but it can take 3 to 4 months for tariffs to be in the inflation data. And I think that is what they're waiting for. So let's talk a little bit about the housing market and how this could impact things. As it stands, rates, like I mentioned, are around 7%, and they've been around that for 2.5 years. And a lot of buyers are waiting on the sidelines, but same with sellers. A lot of people are in their home, maybe they don't really love it, but it doesn't make any sense for them to sell and buy something else and have a monthly payment twice as high because they bought at a 2, 2.5, or 3% mortgage rate. So for them, they're just stuck in their house. So having lower mortgage rates would actually significantly benefit both buyers and sellers. It'll allow sellers to get out of the home that they don't necessarily love and get into something at a reasonable monthly payment. Now, as far as the health of the overall housing market, we are seeing a lot of areas have inventory levels skyrocketing, and everyone knows supply and demand is the major factor that determines the future of home values. Now, we are seeing some areas where inventory is hitting a 10-year high, but where I live in Orange County, California, inventory is still relatively low. We are nowhere near the levels that we saw 2019, 2018, which was a normal housing market. We are still significantly below those levels. But we are seeing in places like Texas, places like Florida, inventory levels are skyrocketing, and it is approaching sort of concerning levels. Now, the overall state of California is still below pre-pandemic inventory levels, which, in my opinion, I think that needs to increase, and I think it will increase. We are still seeing a lot of homes hitting the market in a lot of the state. Still nowhere near as much as Texas and Florida, which, funny thing, both of those states right now combined make up between 1/3 and 1/4 of all listings in the entire country. So you're probably going to have a pretty substantial housing correction in both of those states. Now, California, I would love to see inventory get back to more of a normal level like we saw pre-pandemic. And I would love that for all housing markets. Remember, depending on where you're buying or selling, the market could be a hot seller's market or it could be a deep buyer's market. I'm seeing things in Southern California that change just from city to city. You're having home insurance be an issue in areas where you have high fire risk, which is driving down home values because buyers are conscious of their monthly payment, and home insurance is now becoming a major factor. You're also seeing new construction. Neighborhoods where you're having a lot of new builds are driving down home values substantially. You're seeing home builders sitting on a huge amount of inventory, approaching levels of the financial crisis, yet you're seeing real inventory, existing home inventory, not even near those levels. But builders are struggling, so they are offering an enormous amount of incentives, dropping prices, reducing buyers' mortgage rates to get them into a new home so they can sell it, turn that around, and build something new. And that is affecting home values in areas where you're having a lot of new construction, which is why I think parts of Texas and Florida are likely going to experience a pretty significant housing crash, where you have a lot of Southern California, where I live. There's not really much land available for new builds. There are pockets that are having a lot of new construction, but still it's nothing like other states in the country. Now, my expectation for where mortgage rates will be headed in the second half of this year and into 2026 largely depends on the unemployment rate. I think if we get unemployment back above 4.5%, approaching 5%, we're probably going to have mortgage rates in the mid to high fives pretty quickly, as well as if we can get inflation confirming that it's going to be below 2%, that'll give the Fed a pretty solid green light to cut rates multiple times, which in turn will help mortgage rates to drop. Now keep in mind, we could actually have no rate cuts, high unemployment, and lower inflation, and mortgage rates could still be lower because they follow the 10-year Treasury yield, which is directly correlated to essentially how the economy is doing. If the economy is slowing down and looking like we're going to head into a recession, the 10-year Treasury drops, which causes mortgage rates to drop. And vice versa, if unemployment goes down for some reason, inflation goes back up, GDP growth increases, stock market continue to hit an all-time high, which it's about to do at the time of making this video, then the 10-year Treasury typically increases because the economy is strong, and that causes mortgage rates to increase as well. My opinion, I do think we are going to have at least one rate cut in the second half of this year, and likely 4 to 5 in 2026, starting in Q1 of next year. I do think by the end of next year, we will likely have mortgage rates somewhere in the mid to high fives. And I don't think we're going to get 2.5–3% mortgage rates, at least for the next 40 years, unless we enter a significant recession/financial crisis, which will force the Fed to stimulate the economy, pump a lot of money into the system, and cut rates drastically. But keep in mind, if that does happen, the housing market is still going to crash. Like we saw in 2008, they cut rates every single month, and home values dropped by essentially 50% in a lot of the country. That's kind of it for the video. Let me know your thoughts in the comments. And once again, my name's Ian Phillips. I'm a realtor in Southern California. So if you're looking for an agent, reach out. I love to chat. And if you like this video, subscribe for more. I'll see you next time.